Again, guys, and today we're going to finish chapter 1, lesson on transaction analysis. And we went over a couple of things last time, and right now we need to focus on how the accounting equation is affected by certain transactions. Transactions are just simply events or activities that take place during a particular period. Okay, and so as we remember our accounting equation is assets equals liabilities plus stockholders' equity. Okay, we know what our assets, those economic resources that provide a future benefit. Liabilities are things that we owe, in which we say that we owe to outside individuals. And we talked about stockholders' equity, breaking down into two parts: paid in capital, retained earnings. Paid in capital being simply whenever you issue stock. Retained earnings is simply income. Income, as we know, is derived from our revenues minus expenses, as we stated in previous lectures. So we're going to pick up where we stopped off on page 16 out of your textbook. And basically we went over 3 transactions and we saw how they was affected with the accounting equation. And so moving forward, we're going to go on to transaction 4. Transaction 4 says that suppose that we provide a service and receive cash. So let's suppose that we provide a service and receive cash of $5,500. Again, start identifying the keywords, where the keywords, making sure that you understand that the keywords will direct you to whatever account that needs to be affected. Okay, so again, the sentence is, suppose that we provide a service and receive cash of $5,500. What are the key words? Providing the service is a key set of words, and receiving cash. Okay, keywords: providing service, receiving cash. Providing service, we have a terminology that consists of whenever you provide a service or you sell a product. That's revenue. Okay, so we know we're dealing with a revenue account. We also know that revenues affect what part of the accounting equation? Revenues affect stockholders' equity. How? Because revenues is a product of income, right? Remember, income is your revenues minus your expenses. That's how you generate income. And so the fact that we provided a service, we know that our stockholders' equity is being affected. It's affecting our retained earnings, because retained earnings in one word definition is income. So $5,500 increased our stockholders' equity, and it increased it through what account? Revenue. Again, we need to realize how is it going to finish this particular transaction. We have liabilities, things that we owe. We provided a service, nothing was owed. Okay, so that's 0. And now we go to our assets. What was one of the keywords that we identified? Cash. So we know that cash is coming into the business. Therefore, cash is an asset. So our assets are increasing by $5,500. Which account is being affected? Cash. So now we have 5,500 equals 5,500. Okay. Next transaction. Suppose that the next transaction states that, suppose we provide a service on account for $3,000. Suppose that we provide a service on account for $3,000. Again, your first step, guys, your first step all the time. Trust me on this. The first step on the method that you need to be doing at this level is identifying keywords. Provide a service on account for $3,000. What are the keywords? Provide a service, account. Those are your keywords that you need to be identifying. Go back to your 2-second business if you feel the need to try to further visualize the concept what's going on. Suppose that you provided a service and you provided it on an account. Let's identify the first half. Providing a service, again, revolves around which particular account? Revenue. Revenue occurs whenever you provide a service or sell a product. So again, our revenue will increase our stockholders' equity. Stockholders' equity is going up by $3,000. Why? Because retained earnings is a part of stockholders' equity. And retained earnings, one word definition again, is income. And income is generated from your revenues minus expenses. So our revenue account is causing our stockholders' equity to increase. Now, the next word that we need to analyze is account. We provided the service on their account. Okay? So we provide a service to a customer on their account. Now, the fact that the keyword is an account means that we're going to have two options to consider. We can either consider it affecting an account called accounts payable, or we can consider it affecting an account called accounts receivable. Two distinct accounts. One accounts payable, one account receivable. It has to affect one of them because of the keyword account. So, which account are we going to deal with? Who provided the service? We did. Do we have to pay that individual because we provided a service? Absolutely not. So we can throw out the distractor of the other account called account payable. Accounts payable means that you're going to pay in the future. That's a liability because you still owe. You're going to pay in the future. But we provided the service, which means that we provided it on the account, and the only other account left to identify is the account what? Receivable. This is an example of you providing a service where no cash is involved. Whenever you provide a service or generate revenue, no cash is involved, you automatically have to create an account receivable. Account receivables affect what? Liabilities? Absolutely not. Accounts payables affect liabilities. Account receivables affect assets. So your assets are going to increase by $3,000. Under which account? Your account receivable. And again, no effects for the liabilities. So as you can see, we're systematically changing the value of our assets based on every transaction. And that will continue to go. But at any given day or any given circumstance, if we start to add up the total value of our assets, just add up all these numbers, we're going to get our balance. And that balance will equal the total value of our liabilities and the total value of our stockholders' equity at any given time. Okay? As a matter of fact, we'll continue. The next transaction that needs to be analyzed would be, suppose that we paid $2,000 cash for rent. We paid $2,000 cash for rent. Where are the keywords? Paid is a keyword. Paid is a very strategic keyword. Cash is another keyword, and rent. Now, paid is very important, and I'm going to show you guys a little tip about this. And I think I mentioned it before. Anytime that you see the word paid, you automatically know what class. Cash is going down. That's the only way that we can pay for something. When we pay for something in reality, cash will go down. So the fact that the sentence started off with the word paid, we automatically know cash goes down. Now, cash is a what? Asset. So obviously our assets are going down. So a minus, and I think I said it was $2,000 under what account? Cash. What was the next key word? The next key word was rent. 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 What is rent? Rent is one of those things that occur based on day-to-day operations of your company. In order to operate a company, you have to pay rent. And I think that was a definition or explanation of one account or set of accounts that we spoke of earlier. Those accounts are called what? Expenses. Rent is an example of an expense. Paying utilities is an example. Advertising is an example. What's another example? Salaries, paying salaries. Okay, so you just have to feel your way through them. Insurance, another example. Okay, and so how will this expense affect the accounting equation? Okay, does it affect liabilities? No, liabilities are things that we owe. Does it affect assets? No, the fact that we paid on it, it did. But does expense itself affect assets? No. Does it affect stockholders' equity? Of course it does. How? What section does it affect? Retained earnings. Again, retained earnings, one word definition. Income. Income is measured in accounting. Revenues minus expenses. Expenses do what to income? Pull it down. Therefore, expenses should do what to stockholders' equity? Pull it down. So our stockholders' equity is going down $2,000, and it's going down through our rent expense account. Rent expense account.